10-year-old Warren Buffett would wait for the crowds to leave the Aksar Ben horse racing track before starting his search. He spent hours scouring the dirt for discarded betting tickets, betting on the high probability that intoxicated gamblers had accidentally tossed away winning slips. Decades later, a group of 7th graders at St. Agnes School applied a similarly focused strategy. Their simple portfolio returned 70% over 2 years, more than doubling the 26% gains seen in the S&P 500 index. These anomalies stand in stark contrast to the experience of the average retail investor. Most people believe high returns require an MBA or complex Excel skills, leading to a state of constant exhaustion and confusion. This exhaustion often stems from timing the market. Obsessing over the perfect moment to enter or exit a position is a curse that drains an investor's energy while offering no guarantee of success. Successful legends avoid the guessing game entirely. They use a strict mechanical filter to process everyday observations into wealth, separating a few high-value opportunities from a rush of useless noise. Winning in the stock market is a process of ruthless elimination. You remove the bad options until only the inimitable winners remain. The first layer of the filter is relentless reading. Warren Buffett spends 5 to 6 hours a day studying manuals and annual reports, operating on the principle that knowledge compounds exactly like money. Peter Lynch expanded this search to the real world. He hunted for signals in public enthusiasm, following a simple rule: look for the stocks behind the products people already love. While at the mall, Lynch noticed his daughters bypassing the gap to crowd into a packed body shop, full of customers buying lotions and creams. He analyzed the company's fundamentals, saw a global expansion progress, and recommended the stock before it multiplied in value many times over. Once a product is identified, the filter checks the company's size. High-growth opportunities are mathematically more likely to be found in smaller companies than in massive established corporations. Consider a giant like Reliance, with a market cap of 16 lakh crore. For an investor to see a 10-fold return, the company would have to reach an almost impossible 160 lakh crore. A small-cap company can achieve that same 10-fold growth with a fraction of the capital. Phase 1 of the filter leaves us with smaller companies that have significant room to grow, backed by genuine public enthusiasm for their products. Surviving candidates then face the second phase of the filter, a test of fundamental understanding. The St. Agnes 7th graders used a brutal screening rule. If they couldn't explain what a company made and how it made money simply enough for a child to understand, the stock was rejected. Complexity is a red flag. If a business model requires a multi-page thesis to explain its basic product, it is immediately removed from the filter. The final, most rigorous stage of the filter focuses on the math of survival, looking past reported earnings to find the actual cash. Reported profits can be an illusion. Companies often record earnings on their financial reports, even if the customers haven't actually paid their bills yet. If a business earns 1 crore in profit, but must spend 99 lakhs on a new machine just to keep running next year, that profit is effectively gone. The remaining 1 lakh is the free cash flow, the only money that belongs to the owners. This gap is visible in Reliance's 2021 financials. On paper, the company reported towering earnings of nearly 50,000 crore. However, actual cash tells a different story. High capital requirements plunged them to a negative free cash flow of over 13,000 crore. Free cash flow is calculated by subtracting capital expenditure from operating cash. Sprawling industrial plants and refineries illustrate the massive, constant reinvestment required to keep heavy industries alive. Free cash flow is the ultimate indicator of health. If a company bleeds actual cash to maintain its reported profits, it fails the final filter. How many stocks actually survive this 3-phase journey? Deeply researching a company's products, annual reports, and cash flow is an intensive process. Because this level of due diligence requires constant attention, most successful investors find they can only effectively track 8 to 15 companies at a time. Warren Buffett suggests that finding just 3 wonderful businesses in a lifetime is more than enough to achieve significant wealth. This focused approach is the opposite of the chaos found on trading floors, where people gamble on daily price movements without understanding the underlying businesses. Stop trying to time the market. Read relentlessly, run companies through the filter, and treat any business that